Hey everyone, Daniel here and welcome back to another video. Here today, I just updated my long-term price targets for the Tattooed Chef, and in this video, I want to take you guys through exactly why I updated it because of a new news announcement that the Tattooed Chef made pertaining to an acquisition just yesterday. So if you are a little impatient, I am going to make chapters on this video, so if you want to skip to my straight to the long-term price targets, feel free to do so, but I think a little bit of background here is very important first and foremost. What I want to mention here, the Tattooed Chef is growing at a massive clip. They obviously, are growing revenue substantially year in and year out, and are planning on doing so over the next 5, 6, 10 years here, right? This is their guidance from their kind of like investor or analyst today they had just a couple of months ago, and it had them eventually getting to around $1 billion in revenue by 2026, with gross margins of over 35% and thus adjusted EBITDA of over 20% of sales. Very nice adjusted EBITDAs planned for the company in the coming years, right? So I'll look at revenue in a second here, but when we talk about gross margins, I started tracking this company back in 2020, kind of like, I want to say like October-ish, right when they were announced as a SPAC. And what's interesting with the Tattooed Chef, they originally were very deep in private labeled products, meaning that they, made products for companies like Kirkland, which is owned by Costco, and sold them under the Kirkland brand in Costco. Now, the thing with these products is the margins on those were razor thin. And what they've done over the past few months here is really expanded the Tattooed Chef business, which is obviously associated with the Tattooed Chef brand and thus has much higher margins, as because you actually have a brand behind your products, you can charge more for your products. So now when we're talking about the Tattooed Chef here, there's two main kind of drivers of continued growth of profitability at the company. One is the continued elimination of private labeled products from their business. When we're looking at this profitability here of over 30% in gross margins by 2023 to 2026, we're looking at a situation where they are no longer doing private labeled products and they are solely focusing on their branded products, which obviously have much higher margins. And then you also have the tailwind of, scale, right? As you scale your products, as you scale your business, the cost to create and manufacture those products will decrease with time. So you have those two things really funneling into a very nice tailwind going into the next few years here to really drive growth and gross margin at the company. And that's not even mentioning the possibility of them expanding into more profitable products like snacks and chips, which obviously kind of have higher margins associated with them. Now, when we talk about revenue here, I really want to mention, where is this revenue coming from? And this is a slide that was actually updated. They didn't have this in their analyst today, but they updated the slideshow. And it really showcases where they expect growth to come from come to the platform going forwards. And you'll see that a lot of it, originally over the next kind of 1 to 2 years here is going to come from the release of new SKUs, eventually over 200 different products, new platforms. So that's expanding into new stores and obviously product expansion, not just new products, but expanding into new product sectors, which is what we're going to talk about in a second here. But then, looking out further over the next 3 to 5 years, we see them expanding into the grocery aisle, internationally, into convenience stores, licensing, and food service, which will really provide them a nice way to continue growing out their revenue in a massive way over the coming years. Now, I want to show you guys my original price targets, and then we'll go through, the news that happened, and we'll take a look at my updated ones and show you guys exactly what I changed and why. Now, previously, I had the Tattooed Chef actually overperforming here. I think they are actually a little bit conservative with their original estimates of $1 billion in revenue by 2026. I assumed around $1 billion in revenue by 2025. Now, when we talk about this, I really think the growth that they kind of put in to their projections from 2023 to 2026 were much lower than their growth from 2021 to 2023. And I don't think that's really going to take place. I think they're going to continue experiencing growth over the next 5 years here, which is why I had that $1 billion in revenue by 2025. Obviously, use the gross margins of 35% that's given by the company, and since they're also expecting EBITDA margins of over 20%, and you assume potentially 5% of total revenue or closer to 15, 20% of profits going into taxes, you get a net income margin of right around 15%. which leaves the company with $150 million in net income by 2025. You multiply that by a price to earnings ratio of 40, and you get a market cap of over $6 billion, or price per share, $73, over 4x on the upside from today's prices. Now, what changed so significantly that made me change my long-term price targets? The acquisition of New Mexico Food Distributors and Karsten Tortilla Factory. This is an acquisition that is expected to close in early May. The Tattooed Chef paid right around $35 million in cash for these two companies. Let me keep this in mind, that the Tattooed Chef currently has over $150, nearly $200 million in cash sitting on the balance sheet. So they're not even spending that much of it. When we're talking about this acquisition here, for $35 million, they get two main things. One, they get essentially immediate expansion of new facilities. We know that right now the Tattooed Chef is having a production problem where they have so much demand and not enough production to keep up with that demand. These facilities that they just acquired here will allow them to immediately expand their production capacity in a massive way. Not only that, they're going to be able to expand into the Mexican food market, immediately addressing the $1 billion frozen Mexican food category in the United States. When we're talking about the Hispanic and Southwest food sector, that's $20 billion. Now, not only this, they believe that this acquisition here will allow them, or this acquisition rather, will contribute $200 million annually in revenue in the next 2 to 3 years. This is huge, guys, because when we talk about their long-term projections, they don't include any mergers or any acquisitions. This is an acquisition here that will allow them to significantly increase the amount of revenue that they're making as a company, upwards of $200 million. On top of the long-term potential that this brings the company, they also increased their 2021 guidance to now $235 to $242 million in revenue. That currently it was right around $222 million in revenue they were expecting in 2021. And this, keep in mind, this updated guidance does not include any of the potential that these new facilities bring to the company. They also expect gross margins in the range of 20 to 25%. That would be absolutely phenomenal, guys, on their path to 35% margins. And on top of that, they did decrease their adjusted EBITDA, but you need to consider that they are obviously paying a significant amount of money for this new acquisition here. I'm not sure if it will end up on the income statement or not, but you also have to consider that there will be costs associated with actually implementing this facility with their current business. So, this acquisition here, it's phenomenal. It's like a 1 + 1 = 5, where they're paying $30 million, $35 million here today, and they're going to get $200 million in annual revenue in the future. An absolutely phenomenal decision by management. Now let's look at how this impacts my long-term price targets. When we take a look at my targets here, I originally had $250 million in revenue, potential revenue, in 2021. I already expected them to upgrade their guidance because of the fact that, they're experiencing a ton of sell-through. They're continuing to expand into stores, and I really think they sandbagged those expectations. So now that we have an upgrade to potentially $240, $250 million, keep in mind, that doesn't include this most recent acquisition, so it would not surprise me for the Tattooed Chef to get anywhere from $280 to potentially $300 million in revenue in 2021. Now, what did I do going forwards? I somewhat kind of, estimated here, somewhat implemented this new facility that they're going to have, and, we end up with a number of $1.2 billion in revenue by 2025. Obviously, we expect this new facility to bring in an extra $200 million in annual revenue by 2023. So going forwards, this acquisition here might actually bring in closer to $250 to $300 million in revenue by potentially 2025. But I like to be conservative with my estimates, and especially with this, I'm already being a little bit optimistic, going 1 year ahead with that $1 billion in revenue. I think it leaves a bit of leeway for the company. Now, when it comes to profitability, nothing has changed. Gross margins maintaining that 35% range, operating expenses and taxes of 20% gives us a net income margin of 15%, now $180 million in net income by 2025, a 40 price to earnings ratio. The industry generally tends to trade at right around a 15 to 20 price to earnings ratio. So given the growth that the Tattooed Chef brand is experiencing, I think a 40 is a steal. Now, when we talk about, multiplying that by the net income, we get a potential market cap of $7.2 billion, $88 per share, or price upside of potentially a 5x. This is the opportunity that I see with the Tattooed Chef, guys. Let me know what you think in the comment section down below. But just, when it comes to my portfolio positioning in the company, I have right around 18% of my portfolio allocated to the Tattooed Chef. That's kind of partially in calls and partially in equity. I think I have right around 13% of my overall portfolio in Tattooed Chef shares and right around 5% in 2023 call options. So I really like this company. I really like the optimistic kind of viewpoint here of that revenue growth, that net income margin, and the decisions that management is making. I do not see many other management teams making such absolutely phenomenal acquisitions, and seeing this coming from the Tattooed Chef makes me very optimistic about their future and very confident holding 18% of my portfolio in this company. Anyways, guys, thank you so much for watching. I really appreciate you being here. If you enjoy these videos, feel free to hit that thumbs up and subscribe if you're new. And if you know a fellow Tattooed Chef shareholder, feel free to share this video with them. Thank you so much for watching, and have a great day.